Hello, everyone. My name is Zulfiqar, and welcome to another episode of Income Investors. With me today is John Whitefoot with another exciting income pick. If you want to read more about what John writes on a regular basis, you could head to incomeinvestors.com, or you can find the link to the website in the description below. Higher interest rate might be good at curbing inflation, but they are brutal for real estate investment trusts, or REITs for short. And this is because higher interest rates make it more costly to borrow, and REITs borrow a lot of money to increase their portfolios. And those increased costs cut into profits. But with traders pricing in 100% chance of a Fed rate cut this September, investors are beginning to look at REITs again. One REIT that has been doing quite well in spite of higher interest rate is Sabra Healthcare REIT, Inc. They're traded on NASDAQ under symbol SBRA. John?
Thanks, Mo. Yeah, Sabra Healthcare REIT, Inc. is a self-administered, self-managed REIT that owns and operates healthcare industry in the U.S. and Canada. The company's portfolio consists of 374 properties and includes skilled nursing, transition care facilities, managed senior housing properties, leased senior housing properties, and behavioral health facilities, amongst others. The outlook for seniors healthcare REITs like Sabra remains pretty robust. Since the year 2000, the 85 or older population has grown by 55%, compared to an 11% decline in skilled nursing beds, and rising Medicaid and Medicare rates have increased substantially too since the 2020 health crisis. Now, there are a lot of other industry tailwinds that should help support Sabra Health over the long run as well. By 2040, roughly 20% of Americans will be age 65 or older. That's up from 12.5% or 1 in 8 in the year 2000. And between 2020 and 2040, the number of Americans ages 65 and over will more than double, reaching 80 million. And the number of American adults aged 85 and older, the group that often needs the most help with personal care, is expected to quadruple by 2040.
Now let's talk a little bit of numbers here. I know it reported strong first quarter results and reiterates its full year guidance.
Yeah, for the first quarter ended March 31st, 2024, Sabra reported net income of 11 cents per share, and that's up from a loss of 4 cents per share in the same period last year. Now, first quarter funds from operations were flat at 32 cents, while normalized funds from operation increased slightly to 34 cents per share, and adjusted funds from operation and normalized adjusted funds from operation both grew to 35 cents per share. Looking ahead, management reiterated, as you noted, its 2024 earnings guidance ranges, which includes a net income in the range of 53 cents to 57 cents per share, and funds from operation in a range of $1.33 to $1.37 per share. Now, this guidance actually assumes no 2024 acquisitions or sales. Now, the company did note that its investment pipeline has improved and expects to announce new investments on its second quarter earnings call. Now, it will be releasing its second quarter results after the markets close on August 7th, 2024. It could result in improved guidance. It certainly has the liquidity to enhance its portfolio with ample cash of over $900 million and $500 million available under the market or ATM equity offering program.
And John, let's talk a little bit about dividends here. I know this REIT declared a quarterly cash dividend of 30 cents per share.
Yeah, before the 2020 health crisis, Sabra had a history of raising its annual dividend 8 times, in fact, from 96 cents per share in 2011 to $1.80 per share in 2019. Now, it held it there in 2019, then cut it to $1.35 per share in 2020, and cut it again to $1.20 per share in 2021. Now, it's not a big surprise. The 2020 health crisis had a huge impact on REITs and especially healthcare REITs. Now, this past May, it declared a quarterly cash dividend of 30 cents per share for $1.20 on an annual basis for a current yield of 7.23%. The big question is, when will the board begin to raise the quarterly distributions again? Now, the company's balance sheet remains pretty solid, but its operations have not fully recovered from the health crisis, so investors may have to contend with a quarterly payout of 30 cents per share for a little while longer.
And John, Sabra stock has been doing well, having recently hit a new record high.
Yeah, while investors patiently wait for the company to hike its quarterly distribution again, they can take solace in knowing that its share price is thrashing the broader market. As of this recording, Sabra stock is up 26% over the last 6 months, around 19% year to date, and up 36% year over year. Sabra stock, as you noted, actually hit a new record intraday high of $16.89 on July 24th, and the outlook remains robust, with analysts providing a 12-month record high estimate of $21 per share. Now, the reason to be optimistic: of the 7 analysts providing guidance on Sabra, earnings are projected to climb from 6 cents per share in 2023 to 56 cents per share in 2024 and hit 64 cents per share in 2025.
John, thank you so much for your insights. Sabra Healthcare REIT Inc. is a healthcare REIT with a strong balance sheet, and it continues to rebound from its pre-pandemic lows with improved occupancy rate and growing revenue and earnings. It reported strong first quarter results and reaffirmed its full year guidance, though acquisitions could mean revising that guidance upward. Even without near-term acquisitions, the company's strong free cash flow generation should help it to not just continue to pay dividend 14 years and counting, and eventually raise that payout. That's it for today, and make sure to go to incomeinvestors.com now to get our free special report on 3 income stocks to own today. One of those stocks currently has a dividend yield of 12.7%. You can find the link to incomeinvestors.com in the description below. We'll be back with more income picks soon, so stay tuned. And in the meantime, don't forget to like this video and subscribe to our channel. Goodbye for now.